Ever feel like you're swimming in investment options? Just trying to figure out what actually gives you an edge. We all want that, right? To know what really works. So today we're doing a deep dive into two pretty different ways of thinking about investing. On one side, you've got the big players, the titans, really, those broad market S&P 500 ETFs like STY, VOO, IVV. They're kind of the foundation for a lot of people. But then there's this other interesting contender. It works on a totally different idea. The Invesco S&P 500 Momentum ETF, SPMO for short. Our goal today for you is to unpack what these things actually are, sure, but also their core differences, and look at some surprising performance trends, the risks, the opportunities. It's about figuring out how these strategies might actually fit into your own approach.
Yeah, it's definitely more than just picking tickers, isn't it? It's about understanding the philosophy. Are you trying to capture the whole market, or do you want to ride the fastest waves?
Exactly. So let's start with those big guys, the S&P 500 trackers, SPY, VOO, IVV. What's their basic job? Why are they just so, well, everywhere?
Well, these are essentially your passive foundational funds. They're built to do one thing really simply: track the S&P 500 index, the 500 biggest, most representative U.S. companies. So their goal is just to mirror whatever the broad market does, give you instant, wide diversification. You're holding basically all 500 of those stocks. Think of it like your portfolio's bedrock.
Right. Broad exposure, stability,
Huh.
and I know the costs are a huge draw for listeners, too.
Oh, absolutely. That's a
Yeah.
key feature. The management fees are incredibly low, like tiny fractions of a percent. VOO is what, 0.03%? It's almost nothing. Plus, they're super liquid, really easy to buy and sell. So yeah, great for long-term investing, the core of your portfolio. The catch, though, is that they're designed for market returns. You're not really going to beat the market with these. You just match it.
Okay, that makes sense. Solid foundation. Now let's throw in that curveball, SPMO. This isn't just another plain vanilla ETF, right?
Not at all. SPMO, that's the Invesco S&P 500 Momentum ETF. It's what we call a factor-based ETF. It tracks a different index, the S&P 500 Momentum Index. And here's where it gets really interesting. Instead of holding all 500 S&P stocks, SPMO actively screens them. It picks roughly the 100 stocks showing the highest momentum score.
Momentum score, how does it work?
It's based on their price performance over the last 12 months, but, and this is kind of important, it excludes the most recent month. That helps filter out maybe just short-term blips or noise. It's essentially picking the stocks that have been trending upwards, the strongest and longest, then it weights them by both their size and that momentum score.
So it's much more selective, almost like trying to jump on the bandwagon of what's already working. How often does it update that list? Does it stay current?
Oh yeah, it's quite dynamic. It rebalances twice a year, every March and September. So it's constantly adjusting, trying to capture those shifts in market leadership. What styles are working. The core difference here is huge. SPY or VOO just want to beat the market. SPMO is trying to beat the market. It's chasing alpha or outperformance by riding the trend of those hot stocks.
Interesting. Systematically trying to capture that trend persistence. Okay, so let's put them side by side. What do the actual numbers look like? Holdings, costs, that sort of thing?
Well, the differences jump right out. You've got about 500 stocks in the broad ETFs versus only around 100 in SPMO, much more concentrated. And then there's the cost. SPMO's expense ratio is 0.13%, noticeably higher than VO's 0.03% or SPY's 0.09%.
So right away, you're paying a bit more for that active selection.
Exactly. And the question for you, the investor, becomes, is that potential for outperformance worth the extra fee?
And what about dividends? Or how much weight is on the top holdings? I imagine that concentration shows up there too.
It definitely does. Dividend yield on SPMO is lower, typically around maybe 0.4%, maybe up to 0.8%. Compare that to the broad S&P funds, which are usually around 1.3% to 1.5%. But yeah, the concentration is where you really see it. The top 10 stocks in SPMO make up over 55% of the whole fund.
55%. Wow.
Yeah. Names like NVIDIA, Meta, Amazon recently. Compare that to the broad funds where the top 10 might be, around 30%. So SPMO is making a really concentrated bet on those leaders.
That's a huge difference. Okay, but the payoff, presumably, is in the performance. This is where SPMO enthusiasts get excited, right?
Yep.
Especially in bull runs.
Absolutely. Historically, that's where it's tended to shine. During strong trending markets, just look at recent years. SPMO's one-year index return was around 30.5%, while the broad S&P 500 ETFs were closer to, say, 13.5%. Big gap. Go back 3 years, annualized, SPMO is around 24.7% versus maybe 14.4% for the broad market. Even over 10 years, SPMO's track record shows about 16.8% annualized versus the S&P 500's 12.9%.
So consistently higher returns, at least in those time frames. It sounds like it really amps up the gains when the market's heading strongly upwards. Any really stark examples?
Well, think about its return since it launched back in 2015. SPMO's annualized return is around 17.48%. The S&P 500 over that same period, about 13.81%. That's a significant difference over almost a decade. Or just look at 2024 specifically. SPMO returned a whopping 45.81%. VOO returned 24.98%.
Wow. Okay.
So yeah, it clearly shows how it can potentially magnify gains when there's a strong, clear trend in place.
Those numbers are definitely eye-catching, but there's always a but, isn't there? Higher potential reward usually means higher risk. What's the downside here? How bumpy is the ride?
That's the critical trade-off, exactly. While SPMO can soar in trends, it's also inherently more volatile. The potential for bigger drops, bigger drawdowns is higher. That just comes with the territory of being concentrated and chasing trends. Those momentum stocks rotate quickly. So if market leadership changes fast or the style shifts, SPMO can get hit harder than the broad market. It's like driving a sports car faster, yes, but you feel the bumps more.
And you mentioned drawdowns. Is there a risk of something like momentum crash? That sounds unpleasant.
It's a known theoretical risk with momentum strategies, yeah? If you get a really sharp market reversal, like think back to the 2008-2009 crisis, strategies based on what's been hot can suddenly get very cold very fast. It's like everyone trying to sell the same popular stocks at once. Now, SPMO itself hasn't really been tested in that kind of extreme scenario because it only launched in 2015, but it's something you have to be aware of with this style.
Okay, so it's potentially a wilder ride. How do we measure that risk? Are there specific numbers, like metrics, that show the difference compared to VOO or SPY?
Yep, we can look at a few key metrics. First, standard deviation. SPMO typically has a higher number here, which just confirms it's more volatile as price swings are bigger, up and down. Then there's the Sharpe ratio. This is interesting. SPMO actually shows a higher Sharpe ratio historically, around 1.01 versus maybe 0.74 for VOO.
So higher risk-adjusted return, meaning the extra return kind of justified the extra risk.
Exactly. At least historically and under certain market conditions, it suggests you were getting paid more return for each unit of risk you took on. And finally, beta. SPMO's beta usually sits slightly above 1.0. That means it tends to move more than the market. Amplifies the ups, but also amplifies the downs.
And I guess its sector bets must shift around a lot too compared to the steady S&P 500 profile.
Oh, absolutely. It won't look like the broad market at all. SPMO's sector weights are really dynamic. You'll often see it heavily overweight in sectors like, say, tech or consumer discretionary when those are hot, and then underweight areas like healthcare or utilities. It's making concentrated sector bets by its very nature. Plus, it has a really high turnover rate, around 100% annually.
100% turnover. So it's basically replacing its entire portfolio every year.
Pretty much, yeah. Think of it constantly swapping out stocks to keep only the ones with the strongest recent performance. But all that trading comes with implicit costs, trading spreads, market impact, and potentially higher tax implications compared to a buy and hold index fund.
Okay, so putting this all together, for you, the listener who is SPMO actually for, when might it make sense in a portfolio?
Well, it can be a really powerful tool, but it's not for everyone. It could be a good fit if you're aiming for higher potential returns, especially when you think we're in a bull market. If you're okay with more volatility, we're talking potentially 20% or even larger short-term drops. And this is crucial, if you already have a solid base of broad market funds, it shouldn't be your only holding.
Right. And who should probably stay away?
Definitely not for you if you have a low tolerance for risk, or if you need steady dividend income because the yield is lower. Also, probably not ideal if your investment timeline is short, like less than 3 years. Momentum needs time to work. And maybe avoid it, or at least be cautious when the market is super choppy and volatile. Like when the VIX index spikes above 30, that's often when momentum strategies can struggle.
Okay, so for someone who hears all this, likes the potential but wants to be careful about the risk, what are some ways to actually use SPMO smartly? How do you blend it in?
Yeah, great question. The most common and probably sensible approach is the core satellite strategy. You use a broad market ETF like VOO as your main core holding. That's your stability, your shield. Then you allocate a smaller portion of satellite to something like SPMO. That's your targeted growth engine, your spear. We generally suggest keeping that SPMO slice to maybe 15%, perhaps 20% max of your total stock portfolio.
So like 70% VOO, 15% SPMO, maybe some bonds and cash, something like that.
Exactly. That kind of structure gives you broad market exposure, but adds a potential kicker from the momentum factor without letting it dominate your risk profile.
Makes sense. What about managing the volatility once you own it?
Dollar cost averaging, DCA, is your friend here. Just investing a set amount regularly, like monthly or quarterly. It smooths out your purchase price over time, so you're not trying to guess the perfect entry point, which is tough with volatile assets. And definitely think long term, at least 3 years, ideally longer. Momentum goes through cycles. You need patience to ride out the inevitable down periods to hopefully capture the premium over time.
And should you be checking in on it? Rebalancing.
Absolutely. Regular rebalancing is key. Check maybe once a year. If SPMO has shot up and become too large a part of your portfolio, trim it back to your target percentage. Lock in some gains. If it's lagged, maybe top it up slightly. It keeps your intended risk level consistent. Another thing to consider is maybe diversifying your factor exposure.
How do you mean? Like, don't just bet on momentum.
Right. You could pair SPMO with other factor ECFs, maybe add some low volatility like USMV or some value like VTV. This spreads your bets across different investment styles that tend to perform well at different times. So maybe instead of just 15% SPMO, you do 10% SPMO and 10% USMV alongside your core VOO and bonds. It adds another layer of diversification beyond just asset classes.
Interesting. Diversifying the diversifiers, in a way. Any last tactical ideas for managing it based on market conditions?
Well, some people try to be a bit more dynamic. For instance, maybe slightly increase your SPMO allocation when the overall market, the S&P 500, is clearly trending above its long-term moving average, like the 200-day. That often signals a stronger bull phase. And conversely, maybe trim it back if the market falls below that average, suggesting a potential bear market where momentum might struggle more. You could also watch technical indicators like RSI, the relative strength index, for signs of maybe when a trend is getting overbought or oversold, but that starts getting into active timing, which is tricky.
Okay, so wrapping this up, we've looked at the steady giants, SPY, VOO, IVV, representing the whole market, your foundation. And then we have SPMO, the momentum player. More dynamic, more concentrated, aiming for higher returns by riding trends, but definitely coming with more volatility and specific risks. It seems clear SPMO isn't meant to replace those core holdings, but maybe act as a strategic addition for some investors.
That's a perfect way to put it. We used the analogy earlier. Think of VOO as your sturdy shield for that long-term stability. SPMO is more like an agile spear you might use selectively for potential extra growth.
So, given everything we've unpacked today, the whole idea of passive market tracking versus actively chasing momentum, here's something to think about. How might understanding these different investment factors like momentum actually empower you to look at your own portfolio differently? Not just thinking about what you own, but really understanding why you own each piece and what job you expect it to do in your overall financial journey.